How much of our long end is owned by Japan?
Let's just say a important share in terms of APAC of the international investors. We strip out the custodians. APAC are good, say 1/8 to 1/7 out of that, and I think Japan is dominant in terms of all of it. But you will see their data or not see their data in terms of custodian centers elsewhere in Europe as well. When you see high numbers out of Belgium and the UK, a lot of that is going to be Japanese and Asian.
Stephen from Raleigh, North Carolina sends a question in. Unfortunately, Isabel, it's such a damn smart question I have to ask it. Stephen, thank you for this. And folks, this is all part of Bloomberg.com/AskRadio. Questions into Geoffrey Yu. You can't do better than that. You need to be a subscriber to Bloomberg.com. You need to be a terminal user on board with Geoffrey Yu. Stephen from Raleigh, North Carolina. What if we break out Geoffrey Yu above a 5.25%? What if we slip price down, yield up to a 6% 30-year bond?
Well, you tell me where the break even is going to be, and then we can tell you who's going to be buying and who's not going to be selling. If we get to, okay, 5, 6, pick a number. If the break even still stays at 2.5, happy days for domestic pension investors. It's not just the US story. You're seeing that in Europe. You're seeing that in the UK in particular. Let's get the real yield right, because the higher that is, the better it is, given the way demographics are going in the developed world, it is the case. But if break evens go unanchored, if we get to a 3 handle, that's bad news for everyone around.
Geoffrey, the dollar barely reacted to the Treasury's bigger buyback announcement. Is that a warning that maybe the market is losing faith in the U.S. fiscal story?
So you can look at it two ways, actually. Heading into not just this announcement, but also the end July FOMC decision, US exceptionalism, dollar exceptionalism, that was at near record highs. Our clients were very much heading into that, owning US assets unhedged. We are seeing over the last 2 or 3 weeks that they've added to their hedges. The announcement is, I think, going to facilitate that process as well. So again, it's not just about a dollar per se story. Do they still believe in the US growth story? We talk about credibility here and there. The US's growth credibility, and thankfully right now, if you look at all the capex heading into tech, that is independent of whatever the government is doing.
And so if the Fed loses credibility and real yields fall, for example, does the dollar's haven status suddenly become much less powerful in your view?
So haven status is very different from levels. The thing is, there is just no alternative right now. Where else do you go? Like Europe, for example, your real yields are even worse, some of the negative compared to the dollar. Renminbi actually has higher real yields if I just look at the front end stuff. But when you're relying on deflation or very, very low inflation to juice up your real yields, I don't think that's a very good environment either. Yeah.
Way too young, Geoffrey Yu, to remember the joy of August of 1998. But the cacophony of this week, the vibration, the frantic sense of it, are there analogs here with visible leverage or less visible leverage to that difficult August?
So I will say you have to identify where the leverage is, right?
Please.
So we talked about private credit a couple of months ago, right? So without taking a view on private credit, why private credit has been booming over the last few years? Because from GFC onwards, bank credit, that has softened. So private credit is merely just supplanting where bank credit used to be. What really, just as with my economist hat on, so many central banks over the last 20 years, they've removed like M3, M4 monetary aggregates. So we can't track aggregate money supply growth as much as in the past. If we're able to do that now with all forms of shadow credit and the like, I think that's where the concern is. Not with banks anymore and not with where the fishes used to be, but aggregate credit is still an issue.
This is difficult. I understand you've got delicate issues with the Bank of New York. Just to be collegial about it, do you see a total, like what Rogoff and Reinhardt would talk about? Ken Rogoff with me at Jackson Hole next week, folks. Geoffrey Yu, do you see an aggregate leverage now that alludes to previous crises?
Right. So let's just say if I had an M4 number, right, back in the day, then let's look at, but the crucial thing is you've had a high M4 for the sake of argument, but there's high nominal GDP as well. Right. So it's got to be relative. If your money supply growth really supersedes where your GDP is, then it becomes a problem because you can no longer finance that leverage. What the US has in its favor right now, more than anything else, especially compared to Japan, for example, is nominal GDP growth still powering ahead. When that turns, and I'm saying when, because cycles come in place, then I think the regulators and the Fed will all need to be cautious, but we're just not seeing any signs of that yet, at least not in the near future.
And then you also argue that investors shouldn't be aggressively short the dollar. What would actually make you change that view?
Right. So quite a few things, right? Oddly enough, if we're more positive on the current environment right now, if it's going to be global risk on, then you can think about shorting the dollar. The dollar becomes a funding currency. You go into emerging markets, you go into APAC, but that is a benign environment. You know, we go back to a dollar smile of the illustrious Stephen Jen from back in the day, right? Where you have this middle ground with when it's a risk on environment, that's when the dollar serves as a funder. But the issue is, the dollar's yields are still quite high right now. It's expensive to fund out of the dollar. Why? Because growth is still strong, real rates are still high.
I mean, folks, what you just heard there from Geoffrey Yu, he just slips it in like something. But he's talking back from another time, and Stephen Jen, who was definitive at Morgan Stanley, and just beautiful. Geoffrey, you translate that for mere mortals. When you say a smile, are you happy?
You must always be happy with the dollar, but one side of the smile is happier than the other. Put it this way, right?
What is the smile? That's jargon, right, young man.
So when volatility, if you look at when you look at dollar implied volatility, for example, that's the shape of the smile. It goes up, and the dollar does strengthen based on these metrics. You know, when the US is growing strongly, it also strengthens when the world is in a bad place and the dollar's reserve status comes through. The rising dollar, a rising US tide lifts all boats. I still believe in that. That's why I like that side of the right-hand side of the smile, because U.S. demand, U.S. consumers, U.S. corporates, that lifts the world. Everyone's happy.
Jeff, you got a minute left. Mike from Milwaukee emails in. He says, how come Isabel doesn't know about Pabst Blue Ribbon beer? Also, Mike from Milwaukee, Jeff, you seriously, for Bloomberg.com/AskRadio for subscribers and terminal users, Mike wants to know what happens if the Fed becomes unanchored.
So the Fed becomes unanchored, then that is a volatility argument. I'm not going to take a view on levels yet, because let's go back to the Treasury curve. If markets are concerned and you get an equity sell-off, for example, there could be rotation back into bonds again. But if we have an unanchoring where financial conditions are too loose, then you want to own inflation protection. So we're in the middle ground here. Let's see where the US economy goes.